Travis, for decades, investors have heard the phrase cash is king. And in certain markets, in uncertain markets, it kind of feels that way, doesn't it?
Well, yeah, Steve. I mean, when volatility rises and headlines get louder and louder, which very easy to do nowadays, cash feels like a little bit of control, right? Nothing's swinging, nothing's moving or dropping. It just feels like I've got some stability there.
Yeah, Travis, but the reality of it is cash isn't king anymore. The panic and panic investing, reacting emotionally in or out of markets, that's obviously far worse, though.
Yeah, it is, Steve. But again, we'll go back to cash and how people feel, because emotion affects investing, right? I mean, it feels stable because that number does not change on your statement, right? I mean, you might get some interest in there, but stability isn't the same as safety, is it?
So true. Inflation, that's the silent risk.
Yep.
Over the last few years, inflation has averaged well above the historic norms, meaning purchasing power is eroding for investors, and most people don't even really realize it because, to your point, they see the value of $100,000. It's not going down; it's gaining a little bit, but it's the inflation.
Yeah, and we said it before. You know, Warren Buffett calls it the tapeworm. Inflation is the tapeworm that takes its daily bite, whether you like it or not, right? Yeah. So
hell of a way to lose weight, though.
Yeah, yeah. So let's put some numbers to it here, Steve. I mean, if inflation averages, call it 3% a year, which is 1% above the Fed's target of 2%. Your cash, assuming it's a stable cash account, loses almost half its purchasing power over about a 20-year time frame. Half of its purchasing power, right?
Yeah, it's crazy, and even shorter term. Let's look at a shorter time frame. It adds up. We look at a 4% inflation on $100,000. You lose about $4,000 of real value each year by having that $100,000 sitting in cash. I know we're getting a little interest on that, so it's offsetting, but you're still losing money every single year.
Yeah, you are. And as those interest rates get closer to the inflation rate, you're going to see that gap close. So, but here's what people they feel better when they look at their statement, because guess what? There's no red number on there, right?
Correct.
I didn't lose any value this month. You did lose purchasing power.
Yeah.
So
in fact, I made a few $100.
Yeah, right. Yeah.
So holding cash, though, for emergency reserves or short-term needs, makes complete sense, and you should absolutely do that. But holding excess cash for long periods makes no sense, and you're just failing yourself, is what you're doing.
Yeah. We call it bucket one. Yeah. Bucket one should be, full to the extent that you need it, but it shouldn't be overfilled, right?
That's exactly
again,
right.
You're losing the opportunity of other assets.
That's right.
So, I mean, if you take a step back and you go, why are investors sitting in so much cash right now? There's always the headlines. You're always going to have the uncertainty. You're always going to have market volatility for some investors. And flip the TV on and you're going to get what? Constant predictions of, well, maybe we're on a recession's coming, maybe we're in a bubble, maybe there's a crash, maybe everything's resetting. It's just a lot to make someone nervous and say, I don't want to see the number go down, right? So
correct.
So they leave it on the statement. But more stats, Steve. If you look at it, I mean, and we look at this quite a bit, there's quite a bit of dry powder or money market assets on the sidelines. I mean, they've hit record highs here in recent years. I mean, trillions of dollars are sitting on the sidelines right now. I think people maybe have become complacent because of the short-term interest rates and that they've been able to get a reasonable return
on those rates.
But that environment is shifting.
Yeah, and it tells us something important. This isn't about opportunity. It's really about fear. Cash becomes emotional insurance, and it feels like safety, even though it's costing you money long term. I mean, it's costing you a lot of money long term.
Yeah.
And here's where things tend to break down, though. Historically, investors who move in and out of markets based on fear, they underperform drastically. According to multiple long-term studies, the average investor earns several percentage points less per year than the market itself, not because the market's failing them, but their behavior is actually failing them.
Right, and that's generally why people fail in investing. It's behavior based, but again, if we put some numbers to this, and I think a lot of people have heard a statistic like this in the past, but if you just miss the 10 best days in the market over a 20-year time frame, I'm going to say that again, 10 days over a 20-year time frame,
it's a big number,
you can potentially cut your potential returns in half, just missing 10 days, right? Because the problem is those best days, or those 10 best days, often follow the worst days, right? So you have to weather the storm to take advantage of the snapbacks, or take advantage of the best days. And but that's obviously when fear is the highest, and it's hard for people to hold the line during that time frame. That's what we're here for, to help them with that, right? And
that's exactly right.
But because panic investing, as we know, and we've been doing this a long time, Steve, it's not a strategy, it's a reaction. Yeah. It's a normal human reaction. People are gonna consider it, at least, just because they're human. But reactions usually happen at exactly the wrong time. Right. It's almost like clockwork.
Because it is uncomfortable. I mean, like you said, we've been doing this a long time. And it's even uncomfortable for us.
Well, successful investing is being comfortable with uncomfort. Right?
Yes, that's exactly right.
That's exactly right.
You have to get comfortable with being uncomfortable. Yes. Smart investors also, there's some middle ground here. Smart investors don't choose between all cash or all risk, right? I mean, they build intentional cash reserves, like you mentioned earlier, bucket one, for emergencies, for known expenses, or near-term needs that you're going to have. The rest is invested based on long-term needs. Diversification and risk tolerance, not just what CNBC has in those stupid headlines. They just want to catch eyeballs. And we've seen it so much. It just causes people to lose so much money when they're called, hey, I want out.
Yeah.
And our job is to keep them in.
So having the right amount in bucket one, so you can know that your expenses can be met, but then it also gives you that stability to let the other part of your portfolio do its job, right? And that's important, because it's really about having a plan that works in calm markets, which we like, but also stressful ones, So you've got to have that balance, and you've got to understand why you own what you own and the objectives.
Yeah, Travis. So in closing here, the takeaways are simple. Cash isn't king anymore. It truly is strategy.
Yeah, too much cash, again, quietly will erode your wealth over time. And what will destroy your wealth even quicker than that is panic investing, right? Moving in and out, trying to time markets. 10 days in 20 years, if you miss those, it can severely affect your return.
Yeah, that hurts. And so the goal isn't to avoid risk.
No, it's to manage it calmly, intentionally, and consistently, Steve.
That's right, Travis. It's been great. I look forward to it next week.
Look forward to it as well.